Some days in the year, like Christmas or glorious summer holidays, are to be looked forward to. But there's one day that we dread more than any other. No, not Mondays. We are of course talking about the UK budget, which this year will be published on Wednesday the 3rd of March.
The budget is usually an annual event giving the Chancellor of the Exchequer his day in the sun. But the budget is a day to be feared, because it is the day of the year that the Chancellor reveals the many ways that he is going to siphon money from your pocket.
The budget this year is particularly worrying because national debts have soared and somebody has to pay. As financial freedom fighters, this burden is almost certainly going to be forced upon you.
Tax is a subject that might cause the average Joe to doze off, but it's really important to have a good understanding of it because you can't minimise or avoid it if you don't know anything about it. In this video, we're going to be looking at some of the rumours of the big tax hikes that are about to land. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that says you and your finance is free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
Quickly, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake specialises in US stocks for UK investors and offers 3,000 of them. Stake is FCA regulated and has fractional trading.
And they are giving away a free US stock worth up to $100 to everyone who signs up via our link. We'll put the link to the office page in the description below, so be sure to check that out. Now, let's get into the video.
Do we need tax hikes? Before we look at how Rishi is going to stiff us, let's first consider whether tax hikes are even necessary. We're of the view that meddling politicians only make things worse. National debt is astonishingly high at £2.1 trillion, which is 98% of GDP, a level not seen since the early 1960s. As we can see here in this chart, it has increased fivefold since the year 2000.
In the first 10 months of the 2020-21 financial year, government borrowing was $271 billion, which was $222 billion more than in the same period last year. With current borrowing through the roof, it seems highly likely that this debt chart is likely to get a lot worse before it could even begin to get better.
We suppose the silver lining is that the cost of the debt is relatively cheap due to the record low interest rates. In broad terms, there are two ways to deal with debt. You can either pay it down or grow out of it. We would argue that the latter is the best approach and one that has been used successfully many times in the past.
In 1946, after World War II, debt was $24 billion, but by 2008, it was $557 billion. This sounds like a huge increase, but the reality was it had shrunk as a percentage of GDP, which at the end of the day is the only thing that matters. It had in fact fallen from 250% to just 35% of GDP. About 30% of the percentage drop was attributable to real economic growth. The rest was thanks to inflation. Most importantly, the debt burden was reduced in real terms.
Raising taxes will only stifle innovation and kill any hope of business recovery. If people and businesses have to spend too much of their money on taxes, how will the economy have room to grow, which evidently is the only way out of this mess?
Vote-winning policies. The Chancellor is said to have told Tory backbenchers that he was considering a tax hike now to allow him to make cuts before the 2024 election. This sounds like party politics to us, which means taking action to make their party look better, rather than for the public good.
We're never keen on tax hikes, but raising taxes now at this moment of national crisis would be a disaster. The country is on its knees, and even with the fast rollout of COVID vaccines, it appears the easing of lockdowns will be a lot slower than what we all expected, which doesn't bode well for the economy.
Hiking tax now, with a view to lowering it later in order to win an election, is no way to run a country's finances. Now, let's look at the rumoured tax hikes that Rishi wants to punish us all with.
Corporation tax to be raised. Apparently, corporations are evil. They are all controlled by billionaire owners who do not pay their way in the world. This is the inaccurate view of the masses and exacerbated by the media. In reality, corporations are owned by the likes of you and us, from massive companies that you own in your pensions to small businesses owned by hard-working go-getters that struggle day in, day out.
Corporation tax, which is the tax that companies pay on their profits, is rumoured to rise from the current 19% to 23%. It is reported that the rise in corporation tax will be staggered, so it reaches 23% by the next general election in 2024. This rumoured increase is perplexing because the Tory claim was always that cutting the rate of corporation tax in the UK always increases the amount of revenue it raises, and the data supports this as seen here. The Tories gradually cut it from 28% in 2010 to the current rate of 19%, and total receipts have continued to increase. So, deciding to increase the rate to raise more tax seems illogical and counterproductive.
The group this corporation tax hike will hurt the most is of course small businesses. Who was hit the hardest during the lockdowns, often without any support? Small businesses. Who got the least amount of help and in many cases were left to die? That's right, small businesses.
So which group does the Chancellor choose to target with tax increases? That's right, the group that's hanging on by a thread. There are 5.9 million small businesses, which represent 99% of the companies in the UK. So the people being hit by this tax rise are not just faceless tech giants, but ordinary people.
This YouTube channel is a small business which we incorporated as a limited company in 2018 under the false belief that the government was pro-business. We're at the stage of our business where we would like to employ someone to help take the business forward, but tax clearly hinders a business from doing so.
If only they'd continued to let small businesses invest in growing their revenue, then this would generate more tax for the Treasury anyway. Why are millions of small businesses who received no support during the pandemic being asked to subsidise the handouts to employees via the furlough scheme, most of whom will come out of this no worse than before?
As for investors, which includes anyone who has a pension, higher corporation tax means lower business profits and therefore lower share prices and lower dividends and a poorer standard of living for you in retirement.
Stamp duty and the proposed property wealth tax. We detest stamp duty on property because it's a transactional tax that affects people's behaviour. It prevents potential buyers from purchasing a home because of the huge upfront tax that has to be paid, and it also stops those who have a larger house who would like to downsize but can't because of the same reason. Stamp duty interferes too much with the housing market.
Back in July 2020, the Chancellor announced a temporary stamp duty holiday which is due to end on the 31st of March, but reports suggest he is considering a 6-week extension to this tax break. There are other rumours doing the rounds that Rishi is mulling scrapping council tax and stamp duty entirely and replacing them with a property tax.
In theory, a proportional property tax sounds like a much better and fairer means of bringing in tax revenues, but it has a lot of drawbacks and you just know that it's going to be executed poorly. As former US President Ronald Reagan rightly noted, the 9 most terrifying words in the English language are, "I'm from the government and I'm here to help." Over in the US, they have a property wealth tax like this, and they are typically charged around 1.1% per year, though this does vary significantly between states.
The main problem with wealth taxes of this kind is that owning a big property does not mean you are wealthy and have the cash in your bank to pay. It's very likely that many homeowners are asset rich, i.e. the property has gone up in value, but they're cash poor.
The Mirror are saying that it could save Northern and Midlands homes £660 a year, while leading to hikes of up to £1,200 a year in London. We both agree that council tax and stamp duty need reforming, and a property tax is one way to do it, if it's done right.
Income tax, VAT and national insurance promises broken. The government had promised in their 2019 manifesto not to raise income tax, VAT or national insurance across the next parliament. This would mean until 2024, but this promise now looks to be on shaky grounds. Last year, the Chancellor repeatedly refused to rule out any tax rises, even those prohibited by their own manifesto. It wouldn't be the first time a political party has gone back on their word.
One workaround to technically avoid breaking the promise is to scrap salary sacrifice schemes. Many employers offer salary sacrifice schemes that allow employees to reduce their salary in exchange for a larger employer pension contribution. In doing so, there is an income tax and national insurance benefit for the employee. This looks like fruit ready to be picked by the Chancellor.
Pension tax relief is ripe for a shakedown. The rumour that higher rate tax relief for pensions will be cut has been floating around for a while now. How much longer can it survive? A higher rate taxpayer pays tax at 40%, but they can avoid this by contributing into a pension. There have been calls to put all taxpayers on a level playing field, putting the maximum to be reclaimed at 20%.
This would be a huge blow to higher earners, many of whom are Tory voters, so we can see why this tax relief has lingered on for so long. Whether it survives this budget or not, it's only a matter of time before the axe falls down.
Capital gains tax and dividend tax set to hit investors. Every rumoured tax grab mentioned seems to be a full-on assault on my financial freedom plans. A report by the Office of Tax Simplification published last year recommended that capital gains tax be closer aligned with income tax rates. It beggars belief how this can be the proposal.
Capital gains come from money that has already been taxed and was then successfully invested. There's no way that this should be taxed at the same rate as the high income tax rate. Your investments are already being shrunk in real terms every day by inflation, and now they want to tax those inflationary gains up to the hilt. There should be no capital gains tax whatsoever until inflation has been offset.
As to dividends, a proposed basic rate jump from 7.5% to 20% tax means that you may as well just stop investing for dividends outside of an ISA, because the taxman is going to want to take a massive slice.
Question of the day: what do you think of these disgusting tax grabs? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.